Alright guys, welcome back. So, in today's lecture, we're going to be talking about SMT, also known as Smart Money Tool. So, what is SMT? SMT is known as a SMT divergence, which is also known as Smart Money Tool. It refers to the divergence among correlated assets. SMT is a variation among many different types of corrects and correlations. Now, when it comes to time, SMT is only, and I repeat, it's only significant when it is in reference to time. SMT without time is just engineered liquidity and, put simple, irrelevant. Now, I will talk about time and I'll go in depth on time later in the video, but for now, we just want to cover the basics. When it comes to the specifics of SMT, this tool is used by ICT traders to identify the strength between correlated assets. SMT confirms stop runs and should be only used as Confluence only and not as entry alone. Now, before I go any further, I'm sure a lot of people have been wondering where I've been, as I've been on a 7-month hiatus from posting YouTube videos. I posted my first video 13 months ago. After that, posting 5, which leads up to 7 months ago, where I had stopped posting. Now, over those last 7 months, put simple, I've been refining everything I've known, making sure everything I know is up to its highest potential, making sure that the quality of my information, the quality of the words I speak, I'm making sure that they are high. I'm making sure that everything is just perfect. Anyways, on top of that, my data collection has been something I've been prioritizing over the last 7 months, refining my data collection, making sure each aspect of my strategy is perfect. Obviously, nothing's perfect. We're always going to be learning more and more. However, when it comes to what I've been studying, SMT has been the greatest aspect of my trading over the last 7 months. Every single trade I take, there's SMT. As I've learned that every single reversal, there's going to be SMT. It is always there. If you look back in your market, it's going to be everywhere you look. Every single reversal, there's going to be some sort of SMT, some sort of crack and correlation at the point of reversal. And due to that, I made it such a huge part of my strategy. And now, that will be a part of all the videos going forward. Now, the origins of SMT, the concept. So, essentially, it is 2 or 3 correlated assets briefly uncorrelate on a specific time frame, must be the same time frame, which indicates a reversal. SMT divergence can be spotted using highs and lows. For example, one asset forms a higher low while its correlated asset forms a lower low. Before price reverses, it must unsync from the asset that is closely correlated to. This is a cause of all fluctuations. Price simply just falls out of sync, or reverse, gets in sync, then expands. Now, before we get into any chart examples, we want to first cover what it looks like to have a bearish divergence. Bearish divergences can be found at the highs when one asset class takes out buy stops, trades higher, while the other asset is laying behind and yet to take out the liquidity slash high. And you can call that bearish SMT. Here on my chart here, we can see that asset 1 that makes the, or my bad, asset 2 that makes the lower high can be classified as the weaker pair. And we can anticipate asset 2 here to be weaker than the other. This is not always the case, often in regards to the indices, regardless if NQ is the one that makes the higher high or the lower high, NQ does tend to be the one who moves the most. Now, when we get into a chart example of a bearish divergence, we have the S&P 500, the NASDAQ, and the Dow Jones futures. NASDAQ, in this example, fails to make a higher high. Because of this, NASDAQ is classified as the weaker pair, and we'll look to enter on NASDAQ. As you can see, ES puts in a higher high, YM puts in a higher high, NQ puts in a lower high. S&P is just a regular sell, NASDAQ is a stronger sell, and Dow Jones is just another regular sell. When we get into specifics of this example, we can see very closely that the NASDAQ drops 2.16%, while the S&P 500 only drops 1.57%, and the Dow Jones only manages to drop 1.18%. Now, this is very clearly because the NASDAQ is the one who puts in the failure swing. We fail to make a higher high. Now, when we get to a bullish divergence, we see here that this is the exact opposite of a bearish divergence. It can be found at the lows, where one asset takes out a low while the other stays and trades higher. One makes a lower low, one makes a higher low. As we can see here, asset 1 makes a lower low, asset 2 makes a higher low. Due to asset 2 being unwilling to go lower, this is a sign on institutional accumulation. Asset 1 is going to make a run on stops. Asset 2 has, in this example, higher relative strength than asset 1. Now, something to keep in mind with the example that I just showed, I stated that these are assets. When we get to specifics, this is actually pairs, as this is in reference to our currency triad, being euro, the pound, and DXY, as DXY inverses euro and the pound. So I could actually replace this with pair. Now, I'm going to get into a live chart example of a bullish divergence on currencies. We'll see here. Currencies consist of DXY, Euro USD, and GBP USD. This is like our head currency triad. There's many different forex pairs. However, our focus is going to be DXY versus Euro versus pound. So here we can see that pound fails to make a lower low, and same thing with Euro USD, fails to make a lower low. Now, on the other hand, DXY puts in a higher high. Now, due to this, we can think that the euro and the pound will be the stronger pairs. So we'll look to enter on the euro and the pound instead of shorting DXY. So euro is a stronger buy, GBP is a stronger buy, and DXY is just a regular sell. Now, when it comes to correlated crypto pairs, we have Bitcoin versus Ethereum. Now, because I don't directly trade Ethereum or Bitcoin, and I just don't trade crypto in general, I will not be going into any chart examples or going into anything else. Compared to the other two examples we showed with indices and currencies being a triad, crypto is just a duo, Bitcoin versus Ethereum. Now, what confirms SMT? Well, SMT, or my bad, what does SMT confirm? SMT confirms the end of the manipulation, and that's all of its usefulness. SMT is only a confirmation tool for something you are already anticipating. For indices, the job is in its institutional order flow. SMT in the lower time frame is our confirmation for continuation. Again, SMT is purely a confirmation tool to an already existing reversal idea. Now, we properly align this with time, and the result could be quite a solid increase in the ability to spot reversals. Now, something to keep in mind is we can't just rely on one singular SMT alone. Something that a lot of people don't fail to do is having some sort of lower time frame SMT confirming the higher time frame SMT. So that's what we're going to talk about here. Higher time frame SMT is confirmed through lower time frame SMT. So when looking for reversals on the higher time frame, we first need to identify significant liquidity. Now, not every high and low that price forms SMT with matters. It is specific time-based highs and lows. An example of that could be the previous week high. Now, keep in mind I said previous week high, not 2 weeks ago high, not the high from 3 weeks ago, not the high from 5 weeks ago. It is the previous week high, not anything else. Now, lower time from SMT, when identifying lower time from SMT, for reversals, we are also looking at specific times. An example could be the previous 4-hour high. Now, once again, I did not say 4 hours ago, so 8 hours ago. I didn't say the 4-hour high from yesterday. I said the previous 4-hour high, not just any. Now, something else to keep in mind is this is also a hint at time frame alignment. Now, there's certain time frame alignments that Also, if used incorrectly, will result in the failure of SMT. However, an example of the proper time frame alignment is for your previous week high or low to previous 4-hour high and low. Now, let's quickly review some of the stuff we just talked about. Review 1 being SMT is only for confirmation to identify when the smart money orders will enter. All significant price runs will start with an SMT, and SMT is purely a confirmation tool to a pre-existing reversal idea. If your reversal idea lines up with your higher time frame narrative, such as a specific point within your daily power 3 or a specific day within the weekly power 3, then the SMT will continue, more or less confirm the distribution. Now, some examples of a time-based SMT is as follows. You have your, actually, before we get into that, there's multiple stages of SMT. Now, the more stages of SMT you have, the higher probability your trade's going to be. If you just have one stage, we can assume that's going to be lower probability. But if you have stacked SMT, being your 3-stage SMT, your higher time frame, your middle time frame, and your lower time frame, then that gives you a high probability setup. So an example of that would be your higher time frame SMT being your previous month high. From there, you drop down to a middle time frame where you have your previous week high SMT. And after that, your lower time frame being the previous day high SMT. Now you have your lower time frame alignments, but we're not going to get into that. Now, a lot of you guys, most of the people watching this video are more than likely traders who trade on the 1-minute time frame. And to you guys, this is all higher time frame. None of this is lower time frame at all. However, apply this concept of higher time frame, middle time frame, lower time frame to all lower time frames relative to you, and boom, you have yourself a very, very solid blueprint. Now, once again, I'm going to say that I'm not sharing all the significant times I use for SMT, but by using the concepts I'm teaching based off the higher time frame, that will lead you guys down the right path. Now, I'm not talking about any sort of high and low, any sort of previous, it's previous power 3s, not AMDs, power 3s. You must incorporate time. Now, let's get into the conclusions. From this video, you should have learned that all reversals will have SMT. If price moves but there's not SMT, then it is not a reversal, and you can assume that this is engineering liquidity. Go back in the market a few years, show me a reversal without SMT, and I guarantee, even if you don't see SMT, I guarantee I can show it to you. When looking for a reversal, the highest probability reversals will see price be within a higher time frame PD array or a new log/new log when SMT forms. Now, being in a higher time frame PD array or a new log/new log alone does not matter. It does not matter at all. We're not going to reverse unless there's SMT, unless there's some sort of cracking correlation. Now, when it comes to price reversing with SMT alone, that's perfectly fine, but being within a higher time frame PD array or a new log, that just adds much more probability. It is not life or death whether you have it or you don't have it. If everything aligns with your trade, you don't need to have a higher time frame PD array or new log, because yeah, sometimes we're going to be above all-time highs, sometimes we're going to be breaking down and making new lows. With that said, if we are making new all-time highs, you're much more going to have a higher probability just taking longs and so on. So make sure everything, when it comes to SMT, make sure your SMT always aligns with market structure. A lot of big mistake that I see people make is thinking that SMT alone confirms SMT, and that's not the case. Market structure confirms SMT, or I should say that cracks and correlations don't confirm market structure. Market structure confirms cracks and correlations. Take that as you will. But if you guys are not properly utilizing market structure with your cracks and correlations, then you're going to get caught and you're going to get lost more often than not. Now, something I did not bring up for other variations of cracks and correlations is that SMT is not the only crack and correlation that exists. There are many variations, and For this video, I'm not going to talk about any other variations, but in the future, I will. But we'll leave this video as it is. I thank you guys all for watching, for taking your time out of your day, the last 15 minutes, studying under me. If you have any questions, leave in the comments below, or feel free to join my Discord, discord.gg/Vinzier. All other info can be found in the description of this video, and all my info altogether can be found in my guns.lol/Fearing. Now, big credits, big thanks to the Inner Circle Trader, as he is the founder of these concepts. He has shown us the right way to trade, and he's the foundation of us all. Thank you to Ali Khan for, giving me the blueprint of producing videos like this. And a huge thanks to Trader Day for introducing us to time-based SMT and how to properly utilize cracks and correlations. Now, until next week when I post my next video, you guys have a great week. Study this video again and again until you understand it. Until then, I'll see you guys on the next time.